risk management in stock investing. Let's talk about risk management, which is very, very important. You can't talk about investing without talking about risk management. So today we are going to give you 5 risk management techniques you can employ whenever you are investing in the stock market. Before we start, let's make a popular quote. A popular quote according to the father of value, not really the greatest investor. There is a difference between greatest trader and greatest investor. Greatest investor ever lived, Warren Buffett. He said, in stock investing, there is only 2 rules, which he learned from his mentor, Benjamin Graham, which is the father of value investing. He said, rule number 1, don't lose money. Rule number 2, don't forget to rule number 1. So in order not to lose money, one of the techniques you can employ is risk management. And in risk management, there are so many tips and tricks you can use to protect your bottom line. So we are going to talk about the first 5. So this list is not exhaustive. So we are going to talk about first 5 or the 5 major ones. So let's go. So number one risk management is what we call size positioning or position per trade in percentage wise. So what does it mean? It means whenever you want to invest, you should have a sizable amount which you want to allocate per trade. Example, let's say you have $1,000 portfolio, that your account balance is 1,000, and you want to invest in 5 stocks. So according to risk management, you should size your portfolio size in such a way that you have the same exposure per trade in your portfolio. So what you simply need to do is you divide, if that 1,000 is investable, like you have decided to invest $1,000 into the market, out of what you had initially, let's say your total net worth is, let's say, $10,000, and you decided to invest 10% of your $10,000, which is now $1,000. So in that $1,000, you are looking to invest in 5 companies. What you are supposed to do is to divide the $10,000 by 5. That will now give you $200 per trade, $200 per trade, which is equivalent to 20% per trade. So this is how risk management works. If you want to invest in 10 companies, what you need to do is divide the $1,000 by 10, and you now have $100 per trade, $100 per trade. So with this, you have the same risk exposure in all the companies you are investing in. So that if one goes way down on your portfolio, so this risk management is all about allocating the same amount of percentage exposure to your trade in consideration of the total investment you want to make. We also understand there are some people that deploy the strategy of what's it called? They call A plus setup and all those kind of things. So pending those things, so this is the right way to go. Even if you want to deploy they call it dollar cost averaging, that DCA. Remember, if you want to do that also, then you should be deploying a percentage of that part of 10% in that your dollar average cost. Don't go beyond your risk money. If not, if something goes wrong, your portfolio will be affected. So the second one is what we call diversification. So the second risk management technique is diversification. It means remember, whenever you are investing in the stock market, you can do what we call internal diversification and external diversification. So let's talk about internal. Internal diversification comes in such a way that once you inside the stock market you are investing, you diversify the concept of don't put all your eggs in one basket, something might go wrong. So, but you don't also over diversify. So you play what you call concentration, and because they say diversification doesn't mean that you start allocating insignificant amounts of risk to investment, it will make you be overly diversified, so returns will not make sense. Imagine having $100 portfolio and you are investing in 100 companies. That's for $1 per trade. This one now you are over diversifying, which is so you have to apply concentration. So talking of internal diversification, it means when you come to the stock market, you invest in different sectors. You have to know that when you are investing in the stock market, you are investing in businesses, and businesses emerges from different sectors. We have the consumer, we have the consumer staples, we have so many of them. So what you need to do in internal diversification is try to have exposure in different sectors of the economy according to the opportunity at a time. Because there is a time you will come, there will be opportunity in the banking sector, you have exposure to it. So once you have allocated certain amount of your portfolio to the banking sector, you wait. When any other opportunity that is calling up on the banking sector, you don't need to take it again because you have already exposed yourself to it. Then you wait for another sector. This is what we call internal diversification, trying to diversify in the stock market in different sectors. While external diversification comes as a result of you now looking outside the stock market, outside having stocks. Okay, let me a little bit of commodity like gold. So this is external, but we will not talk much about that one until the next video. So we are concentrating on internal diversification because this is a risk management strategy for stock investing. So the third one is what we call hedging. It's a little bit close to the external diversification. So hedging is just trying to use other techniques. So outside you have exposure in, let's say, company A, you can hedge it by also going to the options market or the futures market to also buy put or call option depending on what is happening in volatility. We are going to make a whole video on this options trading or futures trading, but it's a little bit for those who are technically sound and advanced. But just know that people hedge their portfolio. They might have exposure in company A. They have bought company A, but due to some temporal volatility, they might go in the options market or futures market and do some sellings for the time being. So all those things will still show you. So the fourth one is what we call stop loss. So stop loss is a way of admitting that if you are wrong, let your position be taken out. Let's say you invested $1,000 in a particular position, and after doing your proper analysis, which you have talked about, you have two analysis you do in the stock market. We have what we call the qualitative and the quantitative, the numbers and the non-numbers, where we dive into everything that concerns the books of the company. Then technically you look at the chart and look for a good entry using a good entry strategy. Then when you have used that good entry strategy, then there should, if price breaks below that, there should be a limit at which price might go. You know that you were totally wrong or your timing was wrong. So this is what stop loss is all about. People that use stop loss majority of times people that do trading. Investors tend to, they buy. But once there is no significant reason, once their reason for buying has not been invalidated, even if the stock dips, they tend to hold it out. So this is what stop loss. So stop loss is, let's say you bought at a company at $5, then you see price dropping to $2. They might say something is going wrong. They reassess and say, okay, now I'm going to take this loss, and they close out their position. So this is what stop loss is all about. We are still going to make a full view on it. Then the final one is what we call number 5. Remember, number 1 is position sizing or size positioning. The second one